Ever wish you could just, peek into the future? Especially with something like the stock market.
Huh. Yeah, wouldn't that be nice?
Well, we can't exactly do that, but we can take a really deep dive today into what the market might look like around 2030.
Mm-hmm.
And this isn't about crystal balls or anything. It's educated forecasting.
Exactly.
So our mission here is to pull out the most important bits, the key takeaways from, well, a whole stack of expert analysis, economic trends, historical data.
Right. Stuff from top analysts, economists, big institutions.
Yeah, exactly that. We want to help you get really well informed about the potential landscape coming up.
And that's the key, isn't it? You can't predict the future precisely. Nobody can. But understanding the forces shaping it, that gives you a real edge.
A clearer picture.
Yeah, not just what might happen, but why. That's what we're aiming for today, helping you make sense of it all.
Okay, so let's dive in. Let's maybe start by revisiting the fundamentals, the engines driving the market.
Good place to start.
We know the usual suspects, right? Economic growth, company earnings, interest rates. But what are the subtle shifts analysts are seeing there for the next, say, 6 years?
You're right. It's those subtle shifts. The core drivers, yeah, they're constant. GDP, productivity, feeding into corporate earnings, that's the bedrock.
Yeah.
But here's where it gets interesting now. Inflation and interest rates, they aren't just background noise, they're fundamental. They can completely re-rate market values.
How so?
Well, if inflation hangs around, and rates stay higher than we got used to.
Which seems possible?
Right. Analysts suggest it could mean a sort of permanent revaluation, especially for growth stocks. Those far-off future earnings, they get discounted more heavily today.
Ah, so it shifts investor focus.
Right.
Maybe towards value stocks, dividends.
Could be, yeah. And then you've got government policy, regulation, always changing the playing field. And tech innovation, of course. That's just relentless. Plus, you can't ignore the big global events, wars, pandemics, climate stuff.
Right, the wild cards.
Yeah, exactly. They can speed things up or slow things down, hitting all those other factors. It's all connected. Understanding that connection is what's key to looking ahead.
Okay, so that's the bedrock, the engine room. Now, how are those forces being shaped? What are the big currents analysts see pushing us towards 2030? Where does it get really interesting?
Well, the first undeniable shift has to be tech and AI, right?
Definitely. Our sources are all over this. AI, automation, even things like quantum computing. They're poised to really boost productivity, reshape whole industries.
Yeah.
We're talking big names. NVIDIA, Microsoft, Alphabet, Amazon. They'll likely stay huge.
Still dominant.
But it's not just them, is it? There's
Yeah.
potential for new AI-focused companies to become major players, too.
And what's really fascinating there, it's not just buzzwords. It's not just about making things a bit faster or cheaper.
Okay.
The sources suggest AI's real aha moment, if you like, is its power to democratize really sophisticated stuff. Analytics, personalization.
Making it scalable.
Exactly. Turning old business models upside down. It could create new leaders in niches we thought were too small before. It fundamentally changes profitability, the whole economic structure, potentially.
Wow. Okay. And speaking of big shifts, what about green energy, the whole climate transition thing? That's massive, too.
Undeniable, yeah.
So what's the 2030 outlook there for renewables, EVs, those ESG-focused investments? How big is this?
Well, think about the global push for net zero by 2050. That's not just talk. It's triggering a huge reallocation of capital. Massive.
So money flowing into...
Not just solar panels and wind turbines. It's the whole ecosystem.
Yeah.
Grid upgrades, battery storage, decarbonizing heavy industry.
Whole chain.
Yeah. It's reshaping industrial giants, creating totally new market leaders, and ESG, environmental, social governance, that's increasingly important for investors weighing these things up.
Okay. Next up, demographics. Sounds a bit dry, maybe?
Yeah.
But has real economic impact.
Oh, absolutely.
We're talking aging populations, right? Places like the U.S., Europe, China. How does that actually, impact growth, according to the analysts?
Well, the simple view is, an aging population can slow overall growth, fewer workers, potentially less consumption.
I sense a but.
Yeah, but the key insight is the qualitative shift. It's not just more healthcare spending, it's a surge in demand for highly specialized, often premium services.
Like what?
Longevity treatments, biotech, sophisticated home care, automation for seniors, even things tailored for active retirees' travel experiences.
So it redirects investment.
Precisely. It's a major redirection of where the money flows, not just a drag on the economy overall. There are big opportunities within that shift.
Interesting. Okay, looking beyond the established players, Emerging markets, India, Southeast Asia, parts of Africa keep coming up.
Right. Big potential there.
What's the specific angle? Why the focus now for growth towards 2030?
Well, you've got huge populations, infrastructure catching up fast, a growing middle class. It's a classic growth story in many ways.
So global investors might look there more.
Increasingly, yes, diversifying away from maybe slower growing developed markets. They're looking for those growth opportunities. And analysts are watching how these markets, especially in areas like digital payments or even green energy, might actually leapfrog some of the older development path.
Right, skipping steps.
Kind of, yeah.
Okay, one last trend. Crypto and digital finance. Blockchain. Tokenized assets. Is this finally going mainstream by 2030, integrating into traditional finance?
Uh-huh.
Or staying on the edges?
That really does raise the big question, doesn't it? The potential is absolutely there for deeper integration, but regulation is the massive wild card. Huge. How governments treat stablecoins, how they handle DeFi, decentralized finance, that's going to dictate so much.
So it could go either way. Integrate deeply or face hurdles.
Exactly. The path isn't clear yet. Depends heavily on the regulatory environment that unfolds over the next few years.
Okay, so we've got these big trends: AI, green energy, demographics, emerging markets, digital finance. Now, what are the big institutions actually forecasting based on all this? Keeping in mind, these are outlooks, not guarantees.
Right. Important caveat.
So what are the numbers looking like? Morningstar, back in 2023, they were talking about maybe 5–6% annual real returns for the S&P 500 by 2030, inflation adjusted.
Okay, so moderate.
Yeah. Goldman Sachs. Cautiously optimistic. They specifically pointed to that AI productivity boom we mentioned.
Leaning into the tech story.
Then you've got Cathie Wood, ARK Invest, very bullish, right? Especially on innovation stocks, predicting exponential growth there.
Very different take, yeah.
Vanguard takes a more, Vanguard approach. Average maybe 4–6% per year. They stress having a balanced portfolio.
Classic Vanguard. Steady wins the race.
And BlackRock, sort of neutral to slightly bullish, but they flagged volatility risks, interest rates, politics.
Hedging their bets a bit.
So quite a range.
It really shows you the spectrum, doesn't it? From that cautious optimism like Vanguard or Morningstar to the really high conviction bullish calls like ARK.
Yeah.
And it boils down to their underlying assumptions, right? About the economy, about how fast tech really takes off, about global stability.
So ARK is betting big on disruption.
Exactly. While Vanguard's 4–6% reflects more of a belief in, long-term diversified market returns, perhaps less swayed by any single theme. Two different philosophies playing out in the numbers.
Okay, so we have the trends, we have the forecasts, but what could knock things off course? What does this all mean if things go wrong? Let's talk risks, the speed bumps.
Crucial piece of the puzzle, yeah.
You've mentioned some already geopolitical stuff, rates.
Yeah.
But is there one risk analysts are maybe quietly warning about? Something the market isn't fully pricing in yet?
That's a really good question. I mean, all the risks are significant, obviously. Geopolitical instability, China, Taiwan is huge. U.S. elections always bring uncertainty. Russia, Ukraine continues. Those are front and center.
Right.
Tech regulation to antitrust. Limits on AI that could definitely cap growth in that key sector. Climate change impacts, both physical and financial, are massive long-term threats. Interest rate volatility, if inflation doesn't fade, that changes everything.
But the underestimated one.
Well, the one that often comes up in, let's say, more cautious analyses is debt and deficits, particularly the huge U.S. debt load. Its potential down the line to force difficult choices, higher taxes, maybe higher inflation than expected. It's often acknowledged, but maybe not fully internalized by markets. People might be underestimating the long-term drag or instability it could create.
Okay, so that's definitely one to watch.
Absolutely.
And it's just vital for you listening in to grasp these risks just as much as the potential upside from the trends, right? It's the whole picture.
Couldn't agree more. A comprehensive view needs both.
So the practical question then, given all the trends, the forecasts, the risks, what's your playbook? What are sensible strategies for someone looking out towards 2030? Because let's face it, timing the market perfectly, impossible.
Totally impossible. And trying is usually counterproductive. The key is really focusing on those time-tested long-term strategies.
Like what?
Well, first off, diversification. Seems obvious, but it's crucial. Across different sectors, different parts of the world, don't put all your eggs in, say, just the AI basket or just U.S. stocks.
Might get the risk, okay.
Then, regular rebalancing, making sure your portfolio still matches your goals and how much risk you're comfortable with. Markets shift, so your mix needs adjusting sometimes.
Makes sense. What else?
Dollar cost averaging. This is a big one for writing out volatility.
Explain that simply.
It just means investing a set amount of money at regular intervals, say every month, regardless of what the market's doing.
So you buy more when prices are low.
Exactly. And fewer shares when prices are high. It averages out your purchase price over time, takes the guesswork and emotion out of when to invest. It smooths the ride.
Okay. Good practical tip.
And maybe the most important one. Stay informed, but don't be reactive. Know what's going on, understand these trends and risks we've talked about.
But don't panic sell when headlines get scary.
Precisely. Don't make knee-jerk decisions based on the day's news or market swings. Stick to your long-term plan. These approaches, they've proven themselves through all sorts of market weather. They help you navigate the uncertainty.
Right, solid advice. So that really wraps up our deep dive into the 2030 stock market outlook. We've hit the core drivers, the big trends, AI, green energy, demographics, emerging markets, even digital finance.
Covered a lot of ground.
We looked at the forecasts from the big institutions and, crucially, those risks that could change the picture. Hopefully, understanding all this gives you, our listener, a valuable shortcut to being really well-informed.
Indeed. And, the constant dance between these predicted innovations like AI and the completely unpredictable global events, it makes forecasting both absolutely essential but also inherently uncertain, doesn't it?
Yeah, it's a balancing act.
Which leads to a final thought, maybe. How do you integrate this dynamic balance? This mix of exciting future trends and unavoidable present uncertainties? How do you build that into your approach, not just to investing, but to knowledge and planning in general?
Something definitely worth pondering as you continue your own exploration. Thanks for joining us for this deep dive.
Thanks for tuning in. We'll catch you next time.